right, welcome everyone. Just going to give it another minute or two to let folks spill in. Alexandra, can you hear us? Just give it another minute.
How about now? Can you hear me
There
now?
we go. Welcome.
Can you hear
Yes. Yes.
me? I can hear you guys.
Awesome.
Whoops. Okay. I'm keeping my video off, but
Yep.
I can hear you guys. Woo! We did it.
Excellent. All right,
Chris,
so we've got some people here who have joined. I'll just read our disclaimer, let anybody else come in who needs to, and then we can jump into it.
okay, let's do it.
The opinions expressed in this presentation are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or for on any specific security. Before acting on any information, you should seek independent financial advice. That's us. All securities and financial products involve risks. This information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable. Its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of our control. Past performance is not a reliable indication of future performance. Okay,
Cool.
mouthful.
Ready to rock.
So, all right. And so, if anyone new on the call, we typically go over a couple of our risk indicators, some of the different data points we're watching at, and then dive into some interesting charts we've found throughout the past couple of weeks, or really since the last time that we've met, and dig into what we think's happening, what they're telling us, and where we think we're going.
All right.
So we always start with the U.S. Treasury yield curve, as it's a good signal to tell us sort of the direction of the economy. Where are we headed? Are we headed into a growth and expansion phase or contraction phase or an in-between period? And we've been in this in-between period now for what, 2.5 years?
Yeah.
Something like
And
that.
and just and just I want to remind everybody again, the reason we always start with bonds and fixed income and yields and interest rates is because it is the oil to the economy. It's the engine that gets the economy going. So if there's less liquidity, if there's stress in the fixed income market, it will roll into the economy and it will roll into equities. So that's why we always start here. It's a great measure of risk. Okay. I just wanted to get that in
Yeah. Awesome. Yeah. So I won't go into too much depth on this, but the blue line is the most recent yield curve. Traditionally, these things should have a much more solid shape where it's directionally pointing, up and down or down from high to low or low to high. The fact that we have this real big wobble in wave in it is really indicative of the fact that there's a lot of uncertainty out there, in general.
there.
I mean,
Yeah.
normally you'd want to see what's called a steepened yield curve where the short end, meaning the left side of the graph, is low and the right end is high. That's a signal of a high performing economy where everything is good. When it inverts, where the left side is higher than the right side and the right side's lower, that's the sign of a slowdown in the economy. And what we're seeing now, where there's this big wave in the middle, is super atypical.
Yeah.
Just leave it at that.
And not surprising because of the uncertainty of directionally where the Fed is going. They've started their trajectory to lower interest rates, and then they recently said that they were not inclined to lower in this next time frame. I think they're meeting this week or next week.
Yeah.
And so this doesn't surprise me the way that this looks right now, because of directionally people really don't know where things are headed. We do think it's a bifurcated economy. There are those who are doing extremely well and those who are doing very poorly. And yeah, so it's a very strange bifurcated economy right now. And I think this curve actually shows that.
Yeah, definitely. I wanted to actually take a step back. And for those of you who haven't met him, we have Chris Levene on this call with us. He is a certified financial planner over at the Moneco HQ. He's had some free time and was able to join us for this call. So just wanted to make the introduction
Yeah.
really quick.
Yeah, and he's in our office a few times a week and meeting with our clients and doing all kinds of planning. So he'll be a face you'll see from this point forward for sure.
And today I'll be adding a little color here and there. I think one thing I wanted to say on this chart is we talked about the uncertainty with the Fed, and what you'll find is that every news station has their own opinion of what's going to happen with the Fed in December when they have their meeting. And the number one thing that you should pay attention to is not what they say, it's what actually happens in December. So wait
Yes.
until then, and then you'll really know what's happening.
Yeah.
Otherwise, you're
And from
just listening to talking heads prognosticate.
Yeah, and this is a really good point from our perspective. So, we don't hear about the news, we don't listen. We look at data. We look at data because data tells us where things are headed. And from our perspective, we don't think it's wise for the Fed to stay on hold because we are seeing some chinks in the armor. However, if some of you remember, our theme is that we are in a reverse stagflationary environment. In other words, the cost of necessities will continue to go higher and other things will, either go lower or just stay roughly the same. And so this is, no matter what the Fed does, we think we're in this quagmire right now of higher for those things we need. So, okay, just wanted to add that in.
Next slide here looks at credit spreads. So just to recap quickly, you have your risk-free assets, which would be government treasuries, basket of risks, those, but market views it as the quote unquote risk-free sort of asset being the US Treasury. And then you have a corporate bond, which arguably has more risk than a government. And the spread between what those two bonds pay you is called the credit spread. And so you would expect to see a higher spread between more risky assets and your denominator being the treasury. And so one of the things we track is how different tranches of investment grade bonds, from AAA rated to junk bonds, essentially B rated bonds, how they compare to treasuries. And so when you see huge blowouts in these charts where that spread widens significantly, tells you that there is some big stressor. There's some event happening, something's going on that signals, hey, if I'm going to buy this corporate bond, I expect to be paid a whole lot more. And so we can see in different tranches of credit quality how those spreads in aggregate are shaping up. Lately, there hasn't been that much movement in the investment grade side, but closer to the non-investment grade side. That's sort of that olive brownish colored bar at the top there. You can see over the past few months or so, it's gotten really volatile, meaning it's moving all over the place. So there are risks showing up in those lower credit quality markets. And that's a signal that we pay attention to. Anything to add, Alexandra?
Nothing to add to that. Nope.
At the same time, we've decided, hey, maybe this now looks at the same data, but also compares, instead of the U.S. Treasury, it actually looks at the Swiss bonds, or the Swiss 10-year bond, which we could make a case is arguably less risky than the U.S. Treasury. And so this just gives you another gauge of, where is, like, how are those spreads behaving and acting? And again, it's that lower tier credit quality that's starting to show some movement in it, with everything else generally sort of languishing along. So an interesting comparison.
Check reported ahead on I-95 South. Cool.
Credit default swap spreads just look at, a country's risk of going bankrupt or defaulting on their loans. Didn't really see anything here that requires warning. You can see, though, in the past, like, what is that? What's that gray one? Yeah, there were Italy had issues back in 2011. It just is another gauge for us on the credit side of where are the risks. Right now.
Yeah,
Go ahead.
Yeah, it's showing benign risk. I just want to state one thing, though.
Mm-hmm.
The Western world is at the highest debt, all of us, than we've ever been in.
Yeah.
But this is still showing that there's no stress. I think we're going to pay the price. It's just a question of time.
Yeah. And you can see these can move quickly, right? With some of those spikes in 2020 and 2015 and 2011, where something starts going wrong in a country and the market starts pricing it in, it does it fast. So we like to pay attention to these.
Yep.
Another thing we look at is sort of the plumbing of liquidity and dollar movements around the world. Where's the demand? Where's the supply? Are corporations, banks, insurance companies, hedge funds, do they have the cash on hand or do they not? And are there problems? Why is that important? Because when there are problems, when they have issues getting that liquidity or getting their dollars, that's when you start to see sort of a rapid repricing of assets as people start to sell them as fast as they can in order to raise their cash to meet whatever obligations that they have. What these two charts here show is that we've had a credit facility that the Fed put in place post-COVID that was providing a lot of excess dollars to a lot of these institutions and companies and banks that needed them. But these funds have sort of dried up. And really over the past few months, that facility is no longer being used. And so since then, we are now starting to see other Fed facilities be tapped to get that liquidity. Now, is this a problem? At its face, maybe not, but it's worth paying attention to because it can very quickly become one if different corporations, banks, insurance companies, hedge funds, whoever, need to start relying on these to meet all of their obligations. And so when we start to see these get used more and more and more, that is a sign that there is less liquidity and that there's a lot more stress in those markets.
Exactly. And again, remember, money is what makes the markets go higher. Liquidity is basically what's needed for the economy and for the markets.
Yeah, you've always told me, Alexandra, it's the market smack.
It's the market smack. It's a drug.
Needs that liquidity.
It's a drug of choice.
Yep. This is just another measure that looks at agency fails, and I won't get too far in the weeds here, but basically there's a bunch of overnight lending that happens, and when different parties fail to deliver their collateral overnight, it counts as what's called a treasury or agency fail. And these are all tracked and measured. They get fined for these kind of things. There's normally in a normal economy, there is a baseline that happens. And what we're really looking for are there major spikes here? Because if you get into a situation where all of a sudden third parties are not delivering on their obligations, they're not able to meet their collateral requirements, it again causes those these are sort of the early warning signs that we look for.
Yeah.
And so we see little spikes above the average recently, but as of now, it looks okay. But this can change very quickly as well.
Yep.
So wanted to pivot a little bit and move over to the consumer side, looking at different consumer-facing metrics on how are the people of the United States doing.
And remember, I just want to throw this in there: consumer is 70% of the economy.
Right.
So we're 70% of the gross domestic product. So a healthy consumer is really important to our economy. All right, go ahead, Paul.
Yeah, and so this chart just basically shows the distribution of assets based on net worth tiers. So when you look at those folks who own, 100 million to $1 billion in net assets, where is their money tied up? It's mostly in business interests and stocks. When you look at those who have, say, 100K, well, really $1 million and less in net worth, it's mostly tied up into primary residence and vehicles. So it just shows how bifurcated the market is in terms of who owns what. I've always found
it's a very again, our theme, oligopolies and oligarchs are being created. This is a perfect example of that.
Yep.
This is not healthy in the long run. End of story. Not healthy. And it's not something that just happened. This has been a plan in the works for decades. Can you say money concentrated in a few?
There's some longer term charts. I think we've shown them in some of our previous presentations that show how these have changed over time. And you can see how due to policy, I mean, most of this is policy driven, sort of the ownership of assets accumulates towards the top in terms of productive assets, businesses, stocks, ownership of companies, all those kind of things.
You also one thing that you've definitely heard us talk about in the past, or heard the team talk about in the past, is how there is less and less public companies every single day.
Yes.
And there's
Yeah.
been a concentration that's happening in private companies. Well, that's what that dark blue is, right?
Yep.
You're seeing that there, whereas in the past you may see that the light blue was a larger portion of the, wealthier Americans. They say, okay, I'm gonna buy the S&P 500, things like that. That's happening less and less. You're seeing more and more growth in the private markets because, once again, regulations, things like that are directing their money towards these private companies. So we only expect to see that dark blue grow over time, and for the light blue owning stocks to shrink a little bit. So just something to keep an eye on over time.
It also shows how levered those under $1 million in net worth are to their primary residence, or how important home ownership is for those in the lower brackets. So another thing is, who is spending in this economy? Because we really are in this sort of K-shaped type economy where you have that top. We've heard people maybe say, oh, it's the top 10% are really accounting for the vast majority. And this really proves that, really shows it in the data of the share of total US consumption by income deciles. So it looks at the top, 10%, the next 10%, the next 10%, and who is doing all of the current consumption. And I think the chart really just speaks for itself.
It does speak it. Yep. Yeah. Be curious to see how this Christmas goes in terms of spending.
Mm-hmm. Yeah, I have heard that some of the initial data out, it's obviously incomplete, but they're saying it is, again, this cohort, that top, say, 40% or so, that is still spending, but more selectively. So that's what I've heard so far.
Yep.
Here's looking at jobless claims. You can see continuing claims continue to move upwards. This is concerning.
Yeah. This we don't want to see. I mean, this is obviously, again, money is the engine, right? And if we have more people, who are jobless, this is going to take a bite. A lot of layoffs announced recently too, which is not factored here yet.
Then here's housing data. I'm not sure how complete this data set is, but it is pretty reflective to show that 17% or so, or 1/5, one out of every 5 homes, is owned by an investor and not an actual family. So and this has been a trend that's been going up over the past 25 years.
And again, policy. This is we are allowing BlackRock and Vanguard. Can you hear me okay?
Yep.
We're allowing BlackRock and Vanguard to go ahead and buy these homes, private companies to buy, and it's squeezing our buyers. And there's been discussion about possibly putting in a law to stop this. I think it was Tom Massey who was looking to put in a law to stop these companies from buying homes like they are. And I have to agree with that, because that's squeezing our younger buyers. It's squeezing our younger buyers out of the market. It's not okay. So.
Yeah, I think I read something earlier that was saying the median price for a starter home is now like $425,000 or something like that.
Right.
Whereas even 10 years ago, it was half of that.
Yeah.
So
it's like 220.
Yeah. Mm-hmm. Absolutely insane. Some more housing data, because housing data typically leads sort of what's going on in the economy, because it makes up so much of so many people's balance sheets. What's very interesting is there's 37% more sellers than buyers currently.
Yeah.
It's a very interesting.
See that coming. Yeah, that's coming. The market's gonna, we are way overpriced. So, correction here is not at all. It's not, wouldn't be surprising to us. Mm-hmm. What we have seen, Paul, I don't know if we put this in here, is delinquencies are rising and foreclosures.
I've got that chart.
Okay.
And then looking at the rental market too, where while median rent has come down, it's still really high. But at the same time, vacancy rates have gone up significantly. And Alexandra, I know you can speak to this.
I can speak to this because everyone knows I have rental properties. Yeah, it's changed. The market, the current is changing right now for sure. And, prices for rents have gone up exponentially ridiculous, too much for people. And fortunately, that trend is changing a bit. But also, again, this speaks to, I think, a slowdown generally overall in the whole market.
Yeah.
So, yeah, doesn't surprise me. And when you look at again, you look at the price of the stocks in home building and in the REIT sector, they're all showing that there's going to be a correction in this space. So yeah, that wouldn't be surprising.
All right. This chart just looks at sort of the used vehicle index. So it looks at the pricing of used vehicles. And it's actually, post-COVID, it went straight up pretty much, corrected somewhat, but now it's still going up. So this is it's a pressure that it puts on a lot of people who rely on used vehicles. I mean, the demand is still there. Prices are still extremely elevated. It's concerning. It makes it even harder for Main Street America, really.
Yeah.
Here's some more
Yeah.
employment data. I should have reordered these slides, but this one is just showing that jobs removed, so people posting jobs and then pulling them from their sort of job-seeking markets or whatever, has gone up considerably. And the number of active job posting out there has really just been declining since August, pretty significantly. So this is concerning.
I think, and this was really on the other chart, one thing to kind of pay attention to is you'll hear a lot about initial claims, right? And initial claims has been kind of, bouncing around up, down for a little while. It's that continued claims number that really concerns us, right? That you're seeing in combination with this chart that there's less jobs open for people to take. And meanwhile, there's less and less people getting off of unemployment insurance. That says to
Yes.
us is that if you lose your job, it's not like COVID times where, oh, well, there's six other companies that want me badly. This is, I lost my job and I'm not hearing a lot of clamor
I
from
can find.
help.
Yeah. Yeah.
Good point.
Very valid point.
Yeah, and then this was interesting, I found too. It just looks at college educated job loss rises. So white collar slowdown hits 4-year degrees. So the number of people with 4-year degrees, what's their current overall unemployment? It's around 25%.
On the flip side, I want to say this: if you're in the trades, and this is something that I predicted a long time ago, if you're in the trades, you are becoming a millionaire. And it is happening more and more. So electricians, plumbers, carpenters, the tide is changing. And there's a lot of articles on this now that if you're at all talented, if any of your children, grandchildren bend in that direction, it's a good place to be. And we can even speak to this. We have so many clients who are in the trades, who are very wealthy clients.
Doing great.
So doing great. Yeah. So things are changing. I argue that this is going to change even more significantly with time. So
I think so, especially as AI continues to develop in many of the jobs that could be automated away, will be automated away.
yeah, exactly.
So the leading economic index actually isn't out yet because government shutdown. They don't have the data for the last 2 months. They should get that up and running this month, I believe. But here's another proxy to look at that. Again, the sort of orangish line looks at unemployment rate, which has been creeping up all the way on the right there. And then non-farm payrolls has been dropping down. So that's not a good signal usually. Expectations and sentiment are horrible, but I think that is another reflection of
The shutdown.
The shutdown, right? Partly
Yeah,
politicized, partly due to the fact that, okay, why are certain parts of the economy still look good? Well, that's because that K shape, that 10% or so, they're able to absorb increased prices and all these things, whereas sort of that bottom 90%, it hits them harder. And so who gets surveyed, more of that bottom 90% gets captured. And so of course they're going
exactly.
to say things are not as good as different talking heads are telling me. This I always find interesting. It looks at inflation versus wage growth, and um, inflation has just again surpassed wage growth. So that's
Not
always rough.
good. That's stagflation.
Yeah. Right. The
That's
cost of
stagflation.
necessities and things you need get higher, but wages sort of flatline. And that's exactly what we're seeing.
Yeah.
Here's the delinquency
People don't
chart.
like that word stagflation.
No, no, they don't. This looks at delinquencies 90 days plus delinquent. You could see the red line was just a huge uptick in student loans. That's because they were deferred or whatever for a while, and then that sort of ended recently. But the blue line, credit card debt, I mean, it's almost at 2008 levels, which is pretty wild. And then there's also increases in auto loans and other loans. So delinquencies are rising, and that's always a concern. I mean, auto loans are at, approaching new all-time high levels. So that should be, yeah. Let's
We should
see.
probably start summarizing here soon.
Yep.
Yeah,
Yeah, we don't need to go too much longer. This just looks
no,
at manufacturing and services. Manufacturing numbers last month were not great. They were contractory again. Uh, Pointing to anything below 50 is really saying that there's a slowdown. Manufacturing doesn't look great. There's less orders, less jobs, less momentum in that whole sector. So manufacturing isn't looking good, but there was an uptick in services. Um, and we could probably go into a whole thing about the difference between the two and the shift to a service economy and has that really benefited us as a country. But we'll save that for another
nope,
time.
nope, hasn't.
Uh, and then on the
No,
market, we just found this chart pretty interesting. Um, it's still very narrow participation. One of the things that Alexandra has really taught me is when it's a good economy, a rising tide should be lifting all boats. You would expect
exactly.
everybody to be doing well if the economy is doing well. We are not seeing that. It is very few companies that are sort of keeping the market afloat. And this chart I thought was very interesting. Only three times in history has this says 158 stocks are outperforming the S&P 500 average, which is the third narrowest year ever. It's just wild. And then percent of the S&P that trails the index by 10% or more, meaning that they're doing 10% worse than just the average of them, is over 50% of that whole index. So over 250 companies are doing worse by 10% than the average, which is just wild. And again, shows that it's very narrow participation. It speaks to one of the longer term themes that we've had of consolidation with the bugs, these
Yep.
big companies that are just dominating, these oligopolies that have essentially been
Yep.
formed.
Oligopolies are being created, and it's only getting, it's again, it's not just, it just happened. This has been going on for a long time, and it's all
That's right.
policy driven. All of it is policy driven. All of
Yes.
it. And
Yeah. And
yep.
so that's all we've got for slides. I think
So
yeah, go ahead.
let's summarize here
Mhm.
so everyone knows. Like, of course, we we see more chinks in the armor, but this, you guys, has been going on for a long time. This slow, steady deterioration in our economy has been happening for decades. And speaking to our debt right now, it's significant. So what are we doing right now? We're still we're in silver, we're in gold. Those are hitting new 52-week highs, new all-time highs. What is that saying? That's saying we're going into an inflationary environment. We need to be conservative. We have those in your portfolio. We have a good amount of exposure overseas. We continue to do that. Nothing has really changed in terms of our positioning from our last call, except that we continue to take a little bit more of a conservative posture.
Yep.
We are represented in the market, and we are represented in what we call the bugs. We'll continue to be there. So that's where we stand right now in terms of positioning. Did we get any questions, Paul?
Yep, a few came in. One was talking about AI and sort of the implications of what happens if that unwinds, and how broad is its impact, which I'd say is pretty massive. One of the major differences, I don't know if this matters that much, but it could make some difference, is that when you look at some of the biggest AI players, not specifically ChatGPT and OpenAI, but when you look at some of the other folks like, for example,
Google.
say Google, right?
Yeah.
While they have spent a fortune on AI, they are still making a fortune in terms of money. And that's probably the major difference between the dot-com sort of bubble era and today, is that a lot of those companies didn't have the balance sheets, didn't have the revenue streams to back up their valuations at the time. Whereas today, I don't know if they could really back up their valuations, but they at least have these extremely strong revenue streams that were not present in the past. So it does make I don't want to say it's different this time, right? Famous last words. But it is a different landscape in that sense.
Yep.
Another question we had was around watching out for digital currency, and if there's what that means and what the difference is. Is paper currency going to be eliminated? I mean, we can speculate on this. I'll just throw my 2 cents in, and then Alexandra, if you want to add something, Chris, if you have anything.
I will.
I think paper currency is going to be eliminated, and I think they've already started this process when you look at countries like India that have already moved in that direction of eliminating paper currency. And then you look at some of the new laws and regulations in Europe and the European Union, where they are also moving towards that direction. And then you look at, what sort of countries like China and stuff are doing with social credit systems, completely doing away with paper currencies and moving 100% to electronic. Now, that is different, I would say, in some ways, it's different than what is digital currency in and of itself. The two are related. But this move to like stable coins in things you could argue that all of our currency is already digital, right? Much of it moves on computers and rails. But when you introduce the idea of stable coins and using ledgers, these distributed ledgers and that type of technology for it, it actually adds a whole bunch of controls on top of currency, where you actually have something that you could call programmable money in a way. And on the one hand, it could be used for great things, but let's be serious. What central bank or government is going to give you more power, right?
Right.
And so it allows them to blacklist people, shut off. It is a move towards more control, right? And we're seeing it happen.
And it is happening across the board, you guys. This is I want to just say this. This is a global plan. This is a global plan. During COVID, the world moved together. What you don't know is they're moving together on this as well. It's happening in the UK. It's happening in Europe. They already said they're going to it. It's happening. Digital IDs plus this. And what this will do is it will give them a tremendous amount of power. And who's them? We think it's the technocrats. It's those oligopolies. And this is the problem. And so frankly, yes, we think this is happening. And we would suggest that on your own, you don't need to trust us, on your own, research the World Economic Forum's 2030 agenda and the UN agenda. It's all in there. It's all in there. Ultimately, listen to them. Ultimately, this is about control. And this is a concern. This is an absolute concern. And all of the things that we see happening today are pointing in that direction. So yeah, ultimately, we think this is the direction they will go in. Yeah. Now, I'm not happy about it.
Yeah. And it's always so unfortunate to me, because a lot of the technology behind it represents these pretty amazing tools that you could do very amazing things with. It's just the people in the positions wielding them are in my, I'll speak just for myself, and I think you too, Alexandra, are using them in ways that shame.
It's not okay.
Yeah.
Yeah.
Uh,
Yeah.
so that's all.
When we have one more question, we'll answer this. We do have portfolios where we have clients who rely on income. So we will construct portfolios for income as well. Somebody asked that question.
Yeah, and so if you'd like to get more into that, just reach out to Alexandra and I later, and we can,
Yeah.
specifically speak to your situation.
Yeah. Okay, I think that is it for Q&A, everyone. Thank you always for letting us serve you. And let's hope we don't have a massively snowy winter. At least that's how I feel about it. I don't know about all of you, but I'm not too happy about the winter. But anyway, thank you for joining us, and we'll see you next month. But in the interim, if you have any questions, please don't hesitate to call us.
Absolutely. Happy holidays, everyone. And if you need anything,
Thank you,
we're here.
everyone.
All right.
Okay.
Thanks,
Take
guys.
care. Bye.